Welcome to Iron Financial, where we forge stronger portfolios by stress testing market-moving news. All right, today's target, Kimco Realty, ticker Kim. We're putting them under the microscope. Their stock got a nice little jump after a big earnings announcement. So the question we have to ask is this: is this a truly solid foundation we're looking at, or is it just a fresh coat of paint on a shaky structure? Yeah, exactly. The market loves a good story, and it gets excited way too easily. Our job is to cut through all that noise, kick the tires, and see if the frame can actually handle the weight. Let's get into it. So boom, the market sees Kimco's Q4 2025 earnings report and instantly pops the stock 2.65% in pre-market trading. Wall Street, they definitely liked what they were seeing on the surface. Okay, a 2.5% pop gets clicks, but headlines don't build portfolios. I want to see the blueprints. So lay out the plan for this deep dive. How are we breaking this thing down? All right, here's the game plan. We're going to run a full structural analysis, top to bottom. First, we're going to hit the headline earnings beat, the thing that caused all the commotion. Then, we're going to dig into the foundation, their core operations. After that, we stress test the financial beams holding this whole thing up. We'll review the blueprints for 2026, survey for any potential cracks, and finally, we deliver our verdict.
All right, first things first, let's look at the numbers that lit the fuse on that pre-market pop, the earnings beat itself.
So, the headline numbers, they looked good, no question. They posted earnings per share of 21 cents, completely blowing past the 18-cent forecast. I mean, that's a nearly 17% surprise on the bottom line. On the top line, revenue came in at $542.46 million, just edging out the $537.32 million they were expected to hit. Hold on. They beat expectations, sure, but that revenue beat, it's less than 1%. Come on. Is that really the kind of foundational strength we're looking for? Or is the market just getting way too excited over what's essentially a rounding error? That's a fair point, but you gotta see it as a signal, right? It's the smoke that tells you to check for fire. This top-line number is what sends us digging deeper to see if the engine is actually running strong. So let's do that. Let's see if this momentum is built on a solid operational foundation.
Okay, this is where the rubber meets the road. We're separating the Wall Street hype from the on-the-ground reality. A company's operations, they're the load-bearing walls. And for a real estate investment trust like Kimco, it's all about one thing: leasing.
And wow, their walls look like they're built out of granite. I mean, just look at these numbers. They hit a portfolio occupancy of 96.4%. That matches their all-time high. But here's the real kicker for me. Small shop occupancy hit a new record of 92.7%. That's the hardest part of the retail real estate business. It tells you the demand is deep and wide, not just propped up by a few big anchor tenants. Okay, record highs look great on a slide, but it also means they're hitting a ceiling, right? There's not much room left to grow from here. So how do you even maintain that? I mean, gravity has to kick in at some point. You can't just hover at an all-time high forever.
You're right. You can't just sit there. You maintain it with pure, relentless execution. Listen to their COO, Dave Jamieson. He pointed to a record 1.2 million square feet of new leasing in the fourth quarter alone. See? They're not just defending their territory, they're actively expanding it. And this same drive, this same execution, you can see it in how they absorb new assets.
Yeah, take a look at this. When they bought the RPT portfolio, there was a 120 basis point gap in occupancy. A real gap. In just a short amount of time, they've practically slammed that door shut, narrowing it to just 20 basis points. That's not a fluke. That's proof that their operational platform is superior. And more importantly, it's repeatable. It's not a one-off win. All right, I'll give you that. The execution is definitely sharp. But who's filling these spots? Are these rock-solid tenants, or are they just plugging holes with businesses that might crack the second the economy sneezes next year?
That's the million-dollar question, and their pipeline gives us the answer.
Stifel actually put a spotlight right on this. If you look ahead to the first half of 2026, a massive 87% of the rent that's set to expire is already taken care of, either resolved or there's a deal in the works. And get this, those risky, naked anchor leases, the ones with no renewal options? They had 47 of those expiring this year. They've already handled 98% of them. That's not just planning, that's building a fortress. Okay, you've got me there. That's a very solid forward-looking indicator. But look, operations are just one side of the coin. Let's see if the financial structure holding it all up is just as sturdy.
All right, let's move on to the steel beams of this operation, the financials. This is where we find out if the company is truly built to last. So for their full year 2025, their funds from operations, or FFO as we call it, came in at a staggering $1.2 billion. For anyone new to REITs, FFO is the key metric. It's the lifeblood. And that is a powerful number showing just how much cash their properties are cranking out. And it's not just a big number, it's a growing number. That's a 6.7% jump from the year before. For a company this big, a REIT of this scale, that kind of earnings growth is some serious heavy lifting. It proves the core business isn't just treading water, it's actually gaining speed. Whoa, hold on. Let's pump the brakes for a second and make sure everyone watching is on the same page. Explain FFO for us. It's not the same as profit, is it? It's a specific real estate metric where they add back depreciation. So, what I want to know is, what does this actually mean for the cold, hard cash in the bank after they've paid all their bills and, importantly, their dividends? That is absolutely the right question to ask. And here's the answer you're looking for. $165 million. That's their free cash flow for 2025. And that's after paying out all the dividends and covering all their leasing costs. This is the surplus cash. This is what gives them the muscle to fund their own growth, buy back shares, and make sure that dividend is solid as a rock. Okay, positive free cash flow, that's a huge structural plus. I'll definitely grant you that. But what about the debt? What's the leverage situation? What's this whole thing built on? I was waiting for that one. Their balance sheet is a fortress. Simple as that. Moody's just upgraded them to an A- rating in the fourth quarter. Do you know how rare that is? That puts them in an exclusive club with only about a dozen other REITs. This isn't just a pat on the back. This means flexibility. It means they get cheaper access to capital than almost all of their competitors. Look, that A- rating is impressive, I won't deny it, but the fact remains, they have over $800 million in debt coming due in 2026, and it's at a super low 2.65% rate. Trying to refinance that in today's interest rate environment, that's a guaranteed headwind. That's a crack in the foundation we absolutely cannot ignore. It's a headwind, for sure, but it's a manageable one. It's something they've absolutely planned for. That A- rating is proof. The credit agencies looked at this exact issue and said, yep, they can handle it. In fact, that rating gives them huge leverage when they go to the negotiating table to refinance. And all of this financial strength, this is what allows them to consistently reward their shareholders. And boy, do they reward them. They're offering a dividend yield of 4.73%. They've paid that dividend for 34 straight years. Think about that. And they just jacked it up by another 4%. That's the kind of bedrock reliability that you can only build on a truly solid financial base. All right, so the history looks solid. The foundation seems strong. But we're investors, right? We're buying the future, not the past. So what are the blueprints for 2026? What's the plan to keep this growth machine humming? Their main strategy is something they call smart capital recycling. And here's the crucial point. They're selling off their stable but kind of boring low-growth assets. Think ground leases. And they're selling them at really aggressive 5 to 6% cap rates. Now, for those of you who don't live and breathe this stuff, a lower cap rate means a higher sale price. So basically, they're selling high, and then they take that cash and immediately redeploy it into higher growth shopping centers at way more attractive 6 to 7% cap rates. In other words, they're buying low. This isn't complicated. This creates an immediate, positive investment spread, and it juices the entire growth profile of their portfolio. It's straight-up financial arbitrage, happening right out in the open. Okay, that sounds fantastic on a PowerPoint slide, but in the real world, that is loaded with execution risk. Can they actually get those low cap rates when they sell? Can they find quality assets to buy without getting into a bidding war and overpaying? And what about the massive tax bill they're going to get from selling all those properties? Great questions. They handle the tax hit by using 1031 exchanges. It's a tool that lets them defer capital gains taxes by rolling the money directly into a similar new investment. Their CEO, Connor Flynn, he was very clear on this strategy. And hey, if for some reason they can't shield all the gains, it could trigger a special one-time dividend for shareholders. So it's kind of a win-win. And as for the execution, well, their guidance lays out the whole plan. Right here. Their FFO guidance for 2026 is between $1.80 and $1.84 per share. That's continued growth. They're also guiding for same-property net operating income growth of 2.5% to 3.5%. And they have a clear target to sell off $300 to $500 million worth of assets. This isn't wishful thinking. This is a calculated, engineered plan. All right, let's get real. No structure is flawed. Every good engineer, every good investor looks for the potential points of failure. So let's survey for the cracks. The company's own reports flags a few key risks we need to talk about. Okay, number 1, market saturation. Their whole strategy is focusing on these prime suburban markets. That's a strength, sure, but it also means there might not be that many new places to grow. Second, interest rates, which we've already touched on. This hits their financing costs, and it also hits their tenants' ability to pay rent. And third, you've got supply chain issues.
Any disruptions there could delay their big redevelopment projects, and that pushes out the returns for investors.
You're absolutely right to bring those up. They are real risks. But here's the thing. Those are industry-wide tailwinds, not cracks specific to Kimco's foundation. In fact, you could argue their A- balance sheet makes them more resilient to rate hikes than their peers. And this whole supply-constrained environment, well, that actually helps them by limiting new competition, which lets them push rents higher on the properties they already own.
That's a fair counterpoint. The internal foundation does seem solid, so let's bring it all home. What's the final call on this thing?
Okay, after running all the diagnostics, stripping this thing down to the studs, the evidence is clear. This is a fundamentally sound structure. We're seeing record-breaking operations, powerful FFO that's still growing, a balance sheet that's a legitimate fortress, and a really smart, accretive plan for 2026. The key metrics, they aren't just strong, they're actually accelerating. I have to agree. The internal structure is absolutely solid. My caution here is external. It's about the price. The stock is already bumping up against its 52-week high. You have to assume the market has already baked a lot of this good news into the current price. So while the company itself might be a battleship, investors have to be really careful about paying too much for even the strongest ship, especially with all the macroeconomic storm clouds on the horizon.
So here's the bottom line from our analysis. Kimco has engineered a powerful cash-generating machine, and it has a very clear blueprint for future growth. The operational and financial foundation looks, for all intents and purposes, ironclad. Right, but the final decision, that always rests with you, the investor. The company has proven its internal strength, no doubt. The question you have to answer for your own portfolio is whether the current stock price is a fair value for that strength, or if the market has already built this skyscraper a little too high. As always, you have to do your own due diligence, and that's our deep dive. This is Iron Financial, helping you cut through the market noise and forge a stronger portfolio. Thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.